Hi, I'm Rick Kahler, and thanks for joining me today. Well, unless you've been on a news fast, you know that the world stock markets have taken quite a dive since December. This was the worst January in history for the NASDAQ, which was down 9.9% from the opening on January 1st. And it was the worst January since 1990 for the S&P 500, which was down 6.3%. I've received a number of calls from journalists asking, in light of the recent market downturn, what's an investor to do? Well, my answer is pretty predictable, and it's a reason why not too many journalists call me. My answer is nothing. Nothing, that is, assuming that you have a well thought out asset allocation strategy and that you rebalance your portfolio several times a year. Now, long-time readers of my columns know that a diversified portfolio will include a mixture of world stocks, world bonds, real estate, commodities, market-neutral funds, cash, and TIPS bonds. In a well-diversified portfolio, it's normal to have a year with a 15% loss, as well as having a year with a 25% gain. That is a normal range to produce an overall return of, say, 7 or 8% over the long run. Neither one of those extremes, neither a 15% loss or a 25% gain, means that anything is abnormal or needs to be changed in the portfolio. I've been telling my clients that we are long overdue for a return to a challenging investment climate. The last 5 years have been exceedingly good. No market stays exceedingly good forever. It appears that 2008 may be the down year that I've been expecting for some time. If we are not now in a recession, we probably will be going into a recession sometime this year. It's not unusual to see stock markets turn downward many months prior to the start of a recession, then rebound months before the recession ends. So how low do I think the market will go? Well, I really don't have any clue. But according to Steve Leuthold, who writes a journal called Perception for the Professional, his January 2008 edition, he says that 80% of bear markets bottom out close to median valuation levels. Now, for Steve, the median valuation level would mean a fall of about 11% from where markets closed on December 31st. So that would mean about 1,300 on the S&P and about 11,800 on the Dow. So far, the lows have been 1,326, pretty close on the S&P, and 12,182 on the Dow, again fairly close to that 11.8. Now, the good news is that most bear markets are much shorter in duration than bull markets, lasting about 18 months. Unless you think that there may be some other market in which to hide, the international markets will probably follow the U.S. markets. Now, while we're on the topic of international investments, I've received a number of emails from readers concerned about the decline of the dollar, even to the point of wondering if they should move all of their investments into non-U.S. related securities. Personally, I think this would be a big mistake. The dollar, which fell to new lows last year against the euro, will probably continue its slide in light of the recent interest rate cuts by the Fed. But I suspect that this slide is nearing a bottom. And so does Leuthold, who says his research would show that the euro is extremely overvalued relative to the dollar, and that the dollar would be more fairly valued around $1.35. Currently, it's about $1.50. He expects the long-term outlook for the dollar to be bullish against the euro for these reasons. Number one, the U.S. economic foundation is stronger than Europe's. Number two, in terms of purchasing power, the dollar is significantly undervalued. 3, the U.S. is currently on sale, and don't we know that? Four, the euro is untested during a significant recession or economic crisis. And fifth, no multi-country common currency has stood the test of time. So also interestingly, he suggests that the US dollar and the euro will both weaken against Asian currencies where economic growth is exploding. It's interesting. So while I enjoy speculating as to what the future may hold for world stock and currency markets, I refuse to act on my brilliance or anyone else's. I've learned better that regardless of what I think markets will do or should do, I select a well-rounded asset allocation strategy and stay the course. I have found that it pays great dividends. Thanks for listening.